Today's topic is buying and owning investment property. I would say that I am especially qualified to discuss this because I'm a realtor. I've been a realtor for about 15 years now. I'm an investor. I own investment property. I house hack, which we'll get into later. I also owned a property management business for 10 years. So I'm used to dealing with other people's investment properties, hundreds of them, hundreds and hundreds of them. So I'm definitely qualified to discuss this and more than happy to share my insight. And I think that everybody should own a rental property. I think it is a fantastic way to build wealth and gain passive income. And, unlike the stock market, which, is really kind of hard to understand and master, there's very few people that really know what they're doing. Real estate is a known quantity. You can learn how to make money in real estate. You live in real estate. You probably know people who own real estate. So it's a much more accessible form of wealth building and income generation. And living in the area that we live in Southeast Michigan, this area tends to be really strong for cash flow, unlike a lot of other areas of the country. So our real estate values are a lot lower in comparison to our rental rates. Whereas someplace like California, you could own a property and rent it and be losing money on a monthly basis versus in Detroit and Southeast Michigan, where there's usually a lot of places where you can get cash flow. So this is a really good area to invest in. And so we're lucky that we are, it's all around us. We see it every day, we live in it, so it's much more accessible than something like stocks. So I would encourage everybody to consider purchasing an investment property. It's not risky if you involve the right professionals and you minimize your risk as much as possible. So we're going to talk about analyzing an investment property. We're going to talk about different types of investments. We're going to talk about the realtor's role in this venture, how you can use a realtor to help you kind of get the information that you need. We will talk about cash flow versus equity. We will talk about doing due diligence on an investment property. We'll talk about house hacking. And then I also want to get into, so that's just the purchasing process of finding and purchasing an investment property. We'll also talk about owning an investment property and how to do that. So, and what that's like, and I'll just draw from my experience of managing hundreds and hundreds of rental properties for 10 years and everything that I learned from that process, what to do, what not to do. I had some great property owners who I thought were great investment owners, real estate investment owners. They really knew what they were doing. They kind of had a good vision for owning their properties. And then I thought that there were investors that I worked for that I thought did a terrible job, that just went about it the wrong way. I could see the mistakes that they made. My responsibility was to do what they told me for the most part. Fix that, don't fix that, no, I don't agree with that, evict that person. But having done this on a very high level, I have a lot of advice for property owners and how to work with property managers. So we will get into all that. Okay, so let's start with finding an investment property. So I would recommend the best place to start is to buy what you know, to look at what you know. If you're familiar with a certain neighborhood, if you lived in a certain type of house, start there. I mean, why not start with what you know? I mean, if you know East Point really well, or if you know Detroit really well, you know, those would be the best places to start. So you want to start with what you know. You're going to have a much higher comfort level, and you'll be able to catch up to speed a lot quicker because you probably already know the rental rates for the area, you know the pricing, you know the quality of the houses. So start with what you know. You can also just start with what you're really interested in. But starting somewhere where you are either highly interested or already know the specific area is just going to help keep you interested and motivated. So then, there's the whole idea of different investment classes versus risk. So, if you ever go meet with a financial advisor, they're going to ask you, like, how risk averse are you? So, obviously, the more risks you're willing to take, the more money you can make. So, for example, you could buy, a $30,000 house in Detroit. You might get a 15% return, 20% return on it on paper, which is really high, but the likelihood that something is going to go wrong is also very high, very risky. So you have to decide, are you willing to take the risk to try to maximize that return if everything goes perfect? Because the tendency for a property like that, where you have higher potential eviction rates, you have more potential for tenants to not pay their rent due to just not having a safety net, being one, living paycheck to paycheck and being one crisis away from not being able to pay their rent, in a certain socioeconomic, area. So your house is vacant, maybe it gets broken into, the furnace gets stolen. So, in an area where you're spending less money on an investment with a really high potential rate of return, there's also the high potential for a lot to go wrong. So, and then you kind of have like your mid-class properties. So let's say, so if we just talked about Class C, now we'll talk about Class B. Maybe this is like $125,000 home that you could look at getting somewhere, more stable tenants, higher rents. Maybe your highest return on something like that might be 10-11%, something like that. And then you could go into your really high-end properties where the potential for return might only be, 4, 5, 6%, which is pretty low for what an investor is looking for, but also much more stable property, in a much better area, more likely to gain value faster. So you kind of have to decide, when you're looking at an investment property, how much money do I want to spend, and what's my risk aversion, so that you can start dialing in, like, what are the areas that might work for me. And I think that's where a realtor can really come in handy in this process, is engaging a realtor on the early side to really help you figure out, what are these areas like. If I have this certain budget, what does that buy me? What is my return looking like? I know that, I have clients that come to me, and the first thing that I'll ask them is, like, how much money do you have to spend, and what kind of a return are you looking for? And we'll figure out if how much money they have sort of matches up with what kind of return they can get, and kind of bring them to reality initially to make sure that they're, what they have heard and read about for investing in this area really matches what is real. I have a lot of investors or would-be investors come to me and say, I have $50,000 and, I heard you can get a 20% return on a house like this. And I'll say, well, yeah, if everything goes exactly right, you probably could get that kind of a return. And then I'll go through all of the potential things that I've seen in my times as a property manager that sort of brings that return down. So you kind of have to sometimes bring investors down to reality, because, they hear, how great the rental market is in Detroit, or the investment market. And it is, it's a good market, but you really have to know the specifics and the details of it. So a realtor can also help you with analysis. So, for instance, if we're going to go look at potential, be looking at potential rental properties, you want to know how much is it worth, right? So not just how much are they asking, but how much is it worth? And that's something, or, how much can we get it for? That's something that a good realtor is going to help you with for any kind of purchase. You'll want to know how much can it be rented for, and you'll want to know different data things like taxes and HOA fees, and does the tenant pay water in this situation? What are the taxes going to go up to? What are the maintenance costs? What are the renovation costs? So a realtor is going to be able to kind of help you put together a very basic pro forma. I have a spreadsheet that I always send my new investor clients, and it has all of the formulas built in, so they can start to put all of these numbers together. I'll help them, fill it out the first time, and we'll go over it, and then they'll be able to use that as a tool to analyze their own investment properties going forward. So they really kind of get a sense of, oh, I see, if I spend an extra $5,000 putting in a new kitchen, I'll be able to get an extra $100 of rent, which will give me an extra, 2% return on my investment, things like that. It helps really make decisions on like your purchasing and how you want to manage your properties. So, so I want to say hi to all the people that are joining in right now. Hello, everyone. Feel free to ask a question. I'd be more than happy to answer anything that you have. For those that are just joining, we're talking about buying and owning an investment property. My name is Jan Dykers. I'm with a real estate company called Berkshire Hathaway Home Services. I am an investor myself and a developer, and I ran a property management business, my own business, for 10 years and managed hundreds of properties. So that's the background that I am coming from, and that is why I wanted to impart some of my information to all of you today. So we talked about, analyzing an investment property, and if anybody would like a copy of my pro forma spreadsheet, so you can use that as a tool for yourself, just send me a DM, and I'd be more than happy to send that to you. I'd be more than happy to help you analyze an investment property, so you know kind of how to do that. So when you're looking at analyzing an investment property and you're using a pro forma, you're going to have the income on one side, which is going to be your rent, and maybe, if it's a multi-family property, maybe there's additional income like laundry or something like that, internet. And then you have all of your yearly expenses. You have potentially your mortgage interest. You have your mortgage payment. You have your taxes, your insurance. You have your water and electricity, unless the tenant pays those, gas, things like that. You have, if it's a condominium, you have your HOA fees. You have vacancy rate. So, if the property's not going to be rented every single day of the year, usually people want to figure in some kind of vacancy. Usually it's like 8-10%. You want to add yearly maintenance costs into, and these are just fixing things and not upgrading things, because those are capital improvements and those get handled differently. So those are all of your potential expenses. I think I mentioned utilities, HOA fees, taxes, insurance, all of that. So you kind of really want to understand what all of those costs are going to be. Property management, if you're going to have a property manager help you want to add that in. Leasing fees, you're going to pay somebody to help find you a tenant. You're going to add those in. So basically you've got all your income for the year. You've got all your expenses for the year. If you have your income minus your expenses, that's your net operating income. And then you are going to divide that by the money that you spent on the property. Either if you purchased it in cash, that's like your acquisition of the property, any renovations that you put in, and any of your closing costs. And if you got a mortgage, then it would be just basically what you put in cash. Usually you will find that you're going to get a better return on investment if you mortgage a property, because you're putting in less of your own cash. Yes, you're increasing your expenses because now you're paying as part of your operating costs, you're paying for your mortgage. So it really is also going to depend on your interest rate and how much money you're putting down. But usually the return is much higher when you're getting a mortgage, because you're basically leveraging somebody else's money to buy your property, and you're using the rent to pay it off. So sometimes you will hear or you will see, and I posted about it in my stories today, the acronym, I guess it's an acronym, BRRRR. You'll see that a lot. You can go check it out in my stories to see that. But that is buy, rehab, rent, refinance, and repeat. So the idea, and I guess in this acronym, the idea is that you purchase in cash, you renovate the property. Once it's improved, you refinance, you pull out most of the cash that you've put into it. So that's probably like 80-75% of the cash, because you have to have, some equity in the property. And then you repeat. You take the cash that you've pulled back out of the property, you buy another property. I guess you could also, in this scenario, buy, rehab, rent, refinance, repeat. You could purchase the property with a mortgage, rehab it, refinance it, because you'll have improved it, you'll have given it more value, you'll be able to pull maybe your down payment back out, and then you go and buy another property. So you will continue to be able to kind of recycle your money, use other people's money. Right now, interest rates are super low. They're not as low as if you were going to live in the home, and investors are going to pay a little bit higher of an interest rate, but still historically low. So, which brings me to talking about house hacking. So house hacking is a word I think it probably was first made popular in BRRRR, which is a real estate investment message board, website, support network. So I think that house hacking came from that, but it's a fairly new expression, and it basically means leveraging your own personal home for cash flow. So the benefit of using your personal home as an investment vehicle is because when you get a mortgage on your personal home, you pay lower interest rates than you would if you were an investor, and you also have to put less money down. So we're talking, for an FHA loan, 3.5% down, for a conventional loan, 5% down, versus an investor loan, 20% down. So if you're buying a property and you are going to use your own money and house hack, you can't buy an investment property and not live in it. You have to, the idea is if you're getting a mortgage and you're putting that little down and you're saying you're going to live there, you're going to live there. So the idea is that you live in the house and you use it as an investment vehicle. So examples would be purchasing a 2-family home or a 4-family home. Those are considered residential properties, and you can use a regular loan to purchase those. So if let's say we're purchasing a 2-family home, conventional financing actually requires you to put 15% down for a 2-family home. FHA, 2, 3, 4-family home, 3.5% down. So you can put very little down, live in one of the units, and then use the other unit's income as your income. It'll pay for all of your expenses, and probably then some, and it will help you pay down the property. So that's what we mean by house hacking, is using your personal residence as a vehicle for investment. Another potential house hack could be if you had a single family home, renting out the bedrooms for Airbnb or something like that, getting a roommate and charging them rent, using that to pay down your property. So there's lots of different options for house hacking, even if you have a single family home. But the whole idea is, if you own a piece of real estate and it is your primary residence, how can you manipulate it so that it makes you money, or at least pays for itself? So that's what that term house hacking means. And I would be more than happy to help you if that's something you're interested in. Discuss, what might be a good fit for you. I personally live in a 2-family home, a duplex. I'm in the upper level and I rent at the lower level. And for the most part, I think it pretty much pays my mortgage every month. I've been able to use the equity in that home to go fund other investment projects. So it's been a really great, opportunity for me to leverage. So I refinanced, pulled my cash out, and went and repeated and, invested in another real estate project. So the whole cycle of rehab, rent, refinance, repeat continues. So due diligence. So let's say you find a property that you believe is going to work for you. You've done your initial back of the napkin analysis with your real estate agent or other professional to determine, okay, this return on investment is going to work for me. This is, I want to make an offer. So you're able to kind of figure out what you need to offer to make the numbers work for you based on your analysis. And what's great about working off of a spreadsheet and actually having, something to analyze is that it's a business decision. You're not buying it because it's really pretty and you feel really good about it. You're buying it because on paper it makes sense. And if I go higher than my analysis says that I should, because if I go too high, I'm not going to be able to get the return on investment that I want, then it's not a good deal for me anymore. So using a spreadsheet and a pro forma is a great way to just make sure you're really limiting, you're not, getting any kind of like auction fever, and you're just not purchasing for more than you should because you feel like you just really need to get a property. So you want to be able to set those rules for yourself. So, so once you get the property under contract, normally if the property is rented, then I will ask the other agent or seller, if I'm working for the buyer, to provide certain information about the tenant. I want to see their lease because I want to understand that what they are paying, what the seller said that they were paying is really what they are paying. I want to request all of the expenses for the property. Usually that's going to be more important for a multifamily. If it's just a single family, everybody's going to be spending money on their properties differently. So usually after your home inspection, you're going to really understand how well things have been maintained. Finding out what somebody else pays to have, toilets fixed and things like that, might not be what you would be paying, especially if the person is not maintaining their property well. So the biggest thing is the lease. You want to see a copy of the lease. You want to ask for the tenant's payment history. You want to make sure that they are paying on time. And I also want to see their application. So not all the time that these things are going to be available, but if you're purchasing an investment property, you want to validate that it is still going to be an investment property once you purchase it. I also at the home inspection, hopefully the tenant will be home. They usually are, to really like interview them. What do you like about living here? How has your landlord been? Would you be willing to stay after your lease is over? What would make you want to stay? Is there anything that you would want to see done here? You really want to kind of talk to the tenant. That's always a really good way to find out like all of the intel in advance. I talk up the tenants, at the inspection or walk through whenever I can. You can find out a lot from a tenant, a lot more than a landlord is going to tell you. So you're going to have your home inspection, which could include, sewer inspection and all of that. You're going to analyze you want to validate all of the information in your spreadsheet to make sure all of your numbers are correct, including that regarding the tenant. So you can really figure out how accurate your return on investment calculation is. So those are the things that I would do when analyzing an investment property. We talked about renovations. You definitely want to add a line item for any improvements that the property currently needs, maybe deferred maintenance, like an old roof or, an appliance that stopped working or a super old furnace that you want to update. So you want to make sure that you have a line item in your pro forma for renovations. You may also want to run the analysis of things that you don't have to do but might benefit you. Like I talked about a little bit ago, if I renovated the kitchen, and the bathroom, I could raise the rent from $1,500 to $1,800 a month. And what does that do to my return if I'm spending $15,000 to do that? Is it worth it? So it's always a good way to determine if it is actually worth your time doing those repairs and upgrades. Even if you already own the property and you're deciding, should I do certain cosmetic improvements? A really good way is to go back to your spreadsheet and to plug in the numbers and to figure out, would that really make sense? I want to thank everybody for joining once again and welcome you to throw in a question if you have one. I'd be more than happy to answer it. Okay, so now I will move on to owning an investment property. As I mentioned, I am the owner of an investment property, but I have even more experience because I don't own that much property. I just own my own home and a development project and another property right now that's being fixed up. But I have managed hundreds and hundreds and hundreds of investment properties for property owners. And I have managed the worst, most terrible neighborhoods up to the highest end possible properties in the city of Detroit, like huge spectrum of properties. So I've seen everything. And it is definitely true that the higher end properties are less of a pain in the ass. So just know that, the lower end properties, they might be cheaper. You might be able to make more money off of them, but they're going to be a bigger pain in the ass. You're going to be paying more money for management. You're going to be doing more. You're going to be repairing more. So it's a trade-off. Just going back to buying a property or owning a property, something that we didn't discuss is cash flow versus equity. So, besides the option, the potential for how much money you make off of your investment, how much money you make off of the cash you've actually put into the property, is the idea that your property is going to most likely increase in value during the duration of when you own it. And depending on the area you're in, that you have to decide, do I want, equity heavy? Like, do I want to invest in an area that maybe I'm really not getting a great return? Maybe I'm breaking even on my costs, but I know my property's increasing in value significantly. Do I want a mix of that? Or do I want like all strong cash flow, not as concerned about equity? So these are definitely, questions that you want to think about, that you want to consult your real estate professional to help you determine. And I am not, trained business school like MBA or anything like that. So don't come at me, MBAs. But, there's other ways to analyze investments like the internal rate of return and things like that. And, and that has to do with not only how much cash flow you make, but your equity increase over time. Not 100% sure how to calculate that, but just know that there's definitely different ways to analyze investment properties. Okay, so owning an investment property. All right, so property management. So you have to decide, are you going to manage the property yourself? Are you going to hire a professional to do this for you? If you live locally, you have the option to go either way. If you live in a different state, more than likely you're going to want a property manager, or an area that is significantly further away, because it's a lot easier to keep an eye on things when you're local. So I know this is being a property manager. You would think that I would for sure want to always encourage people to get property managers, but I think there is something to be said if you have the ability to manage the property yourself, at least the first time and at least at the very beginning, because you need to know if they're how they're doing their job. And if you don't know anything about owning your property and managing a tenant and all of that, then you won't know if they're doing a good job or not. So to get that experience, it's helpful to at least try it yourself. Now, that does mean that you need to have all of your resources, like you need to, have an emergency plumber on hand. You need to know that you might be getting calls, emergency calls, if you're maintaining your property well, like not likely that often, if at all. But you at least, if you're going to manage your property yourself, you need to have the understanding that you may have to respond to somebody's issue at a time that's super inconvenient. This is just such as life, and such as owning property. If you cannot deal with that, then hire a management company and build those costs into your pro forma. Usually management companies, my experience is they're going to charge you, between, let's say, 8 and 10% of the rental rate. Usually the lower the rents, the higher the management fee. There may be other fees and costs, like you might have to also pay for management of maintenance on top of that, and other flat fees. So these are all good things that you want to ask a property manager that you're interviewing. It's just like, what are all of the costs? You also want to understand, how they would address a potential issue. And if you've done it yourself, then you'll know what kind of questions to ask. So, if a tenant calls with a furnace that's broken at 11 o'clock at night and it's 50 degrees out, how do they respond to that? Versus if it's 20 degrees, that type of thing. So you really want to make sure that they would respond to things the way you would respond, and that they're going to take care of tenants the way you would want yours taken care of. However, you don't want them also unnecessarily spending your money when maybe you would have done something differently. So when you hire a property manager, you kind of put your faith and trust in them, that they are going to treat you like a client, be your fiduciary, take care of your money and your asset, and not make decisions that are going to cost you more than they should. Now, I'm not saying that You should be cheap about everything, because I have seen over and over and over and over again, the owners who cheap out on everything, the ones who, would rather repair the faucet instead of replacing it, are going to end up repairing that faucet like 4 different times when they could have just bought a faucet and be done with it. Trying to get that every last little bit of juice out of the super old furnace when they could just replace the furnace, not have any more maintenance issues, not having their tenants go through the stress of a furnace breaking at 11 o'clock at night, in the middle of winter. I have found that the owners who take care of their properties and take care of their tenants, because your tenants really feel that. Like, they really feel the faucet's broken, he's going to fix it again. He's not going to replace it. He's fixed it 4 freaking times. They don't feel like you really care about them. Are they going to take care of your property? Are they going to want to renew when their lease is up? If a tenant really feels like they are taken care of, then they likely are going to respond in kind. Now, it's not 100% of the time, but I have seen, for the most part, and I have heard tenants, because I was the intermediary between tenants and owners, when I said, I talked to the owner, they're not willing to do this, or I'm sorry, they're not going to replace that, they're going to send a repair person. I get it from the other end, from the tenant, like, you got to be kidding me. This is ridiculous. I can't believe it. I pay my rent on time, that type of thing. So, you just kind of have to think about maybe seeing the long-term vision. Is it more important to be able to retain tenants longer and ask more money for your properties because they are well maintained? Or do you want to try to milk every dollar out of your property to try to save the most money? I would guarantee that if we ran an analysis in the long term, the owners who put more money in up front ended up ahead, because I see that over and over. I really see that. The ones who cheap out on everything, I don't think they see what they're doing. So something else you have to think about is, as a property owner, what do you want your relationship to be to the property manager if you hire one? So a lot of owners, they hire a property manager, they're not engaged in the process until at the end of the month they get their owner statement and there's an expense or something like that taken out of it, and then all of a sudden they're like, what is this about? You want to give your property manager enough leeway to be able to make decisions without consulting you at every second, but you want to be engaged enough in the relationship that they feel comfortable reaching out to you, that there's kind of like a rapport that you have, so they know kind of like what your expectations are. So you don't want to just be the kind of person that just ignores your property because somebody else is on it. I would also recommend that, use the property managers to collect the rent, deal with the tenants, fix stuff that breaks. But as the owner, I would recommend that you be responsible for more long-term maintenance items. So don't expect the property manager to be paying attention to how old your roof is and when you should be saving for a new one, and all planning ahead. Hey, we're going to replace the roof next year. You should, this is what it should cost. You should save, that should be on you. Property managers, they're not good at that stuff. Not at the level of, that we're talking about here. Maybe property managers that manage giant apartment complexes, they probably get into that stuff a lot more. But we're talking about single condominiums. That is just not what the property managers, that is just not what their day-to-day consists of. So what I would recommend is that you figure out, when you need to replace your furnace, how old it is. your roof, how long you have left in your roof. These are all things that you can have a home inspector tell you, or you can hire an inspector to tell you, and you figure out, tell the property manager, I want to have the gutters cleaned once a year. I want to have my furnace maintained every year. They can do all the stuff for you, but you want to make sure that it is getting done. Don't assume that it is done, because I can promise you, when I was a property manager, even if I offered that service, a lot of people did not want to spend the money on it. Why are we cleaning the gutters? Why are we having the furnace cleaned once a year? Like general maintenance stuff, they just didn't want to do this stuff. So I would recommend, if you are concerned about maintaining your property for long-term preventative maintenance, you be responsible for tracking that. Now, if you say to your property manager, I want to get the roof done in 6 months, I need you to start working on quotes in 3 months, they'll do that stuff for you and they will help with that. But don't expect them to just come to you and say, hey, your roof is getting kind of old. You should probably think about saving up for something. I got a quote. They're not going to put the money up front, because many times they're not going to put the time in up front, because many times the owner is not on the same timeline as the property manager. So just something to think about is be responsible for tracking your own deferred maintenance. And if you want to do things like landscaping, freshening up the landscaping in the spring and making sure everything is tuned up for the fall, make sure you're asking for that stuff or hiring it yourself. Let your property manager deal with the day-to-day stuff. If the roof leaks, they're gonna, deal with it at that point, but they're not going to be contacting you about, your roof is old, it's not leaking yet, but we thought we could start getting you quotes. And, if you want to make sure that it's done correctly, then I would recommend that you own that part of the relationship. Just a recommendation from a property manager who dealt with stuff like that a lot. There's not a ton of time in the day, and you're putting out fires right and left all the time, and keeping up with people's deferred maintenance, long-term maintenance that don't care enough to do it, it's not something that was worth spending my time on. So that's just a tip. Okay, so we got about 15 minutes left. If anybody wanted to ask any questions at all, just go ahead and put something out there. So let's see. So we talked about property manager, the role of property manager. Okay, so leasing. So leasing, your property manager may do for you, or you may hire an outside realtor to do this for you. But either way, the idea is getting a tenant in that is going to pay on time and give you the least amount of headaches. So you want to ask your property manager or your realtor to recommend, what are their recommendations for leasing criteria? Especially if you're new to this and you don't know, you're going to say, you're going to want to make sure the rental income is sufficient, and how stable is their job? Have they been working there for a month, or have they been working there for 3 years? What does their credit look like? Do they have any late payments? It's not just about the score. Do they have any late payments? Are they paying their car on time? I think that's one of the biggest things is, if you don't, I always used to say this when I was a property manager, if you look at a tenant's application and they fall behind on their rent, it's like we'll talk about evictions in a moment. You can, if you stop paying your rent, you're going to have a certain amount of time you can stay in the house undisturbed. If you stop paying your car payment, they will come take your car. So if people can't make their car payments on time, that is the biggest red flag that I would look for. So this is definitely something that, you want to think about. Late payments, previous evictions, how did the person perform in the property? You get a landlord reference, or a couple landlord references. Assets as well. The company that I work for now, we also collected information on how much money the tenant had in their bank account. We wanted to see that you have a minimum of 3 months of rent in your bank account as like a cushion, as like a safety net in case something goes wrong. You have a little money saved. So I always say that applications kind of tell a story about a tenant, an applicant. So you make $100,000 a year and you have no money in the bank. I want to know, what are you doing with your money? That's a red flag. So, somebody who makes a certain amount of money should have some savings. And if they have no savings and no good explanation, then that would be a red flag. That's somebody that, I wouldn't feel comfortable renting to. So you want to ask your real estate agent or your property manager, what are their leasing criteria? You want to give them your criteria. You want to make sure you're aligned so that you understand what decisions they're making for you. Do you need to approve the applicants before the lease gets signed, or is that something your property manager does on your behalf without you? So those are all questions to ask. Okay, so legal stuff, evictions. So most of the time, I would say in Class A and B properties, this is not something that you have to be concerned with. The high end to the mid end properties, you probably only have to deal with something like that if somebody has a major life crisis or they have somehow conned their way into the property. It does happen from time to time that somebody ends up maybe not having the income or the assets they said when they moved in. So that is definitely something that you have to think about. The lower end properties, it happens a lot more because sometimes you do have what we call like professional tenants, and hopefully you can weed those people out with like high, strong rental criteria. But you also have people that just have stuff happen to them and they can't, people that are living paycheck to paycheck are one crisis away from not being able to pay their rent. So is more likely it's going to be a situation like that. Usually people do end up moving out on their own, although you do have to get started in the eviction process. I can count on my hands if I've started eviction proceedings with 1,000 tenants over the past 10 years, I've probably only booted, maybe less than 10% of that, maybe 2 to 3%, where the bailiff actually comes and takes the tenant, their stuff out of the property and puts it into a dumpster. That is a very rare occurrence. Most people know they need to get out before that happens. So, but if you don't file in court, then you are not going to, you're not going to be able to move the process along. And then people will think that they can just stay as long as they want to. So usually you want to get an eviction attorney. There are a lot of people out there that specialize in evictions. Usually they do it for like a flat fee or something like that. So it's always good to kind of have that person at your disposal, or be using a property manager who has an attorney that deals with that kind of thing. So there's a whole process that you have to go through, and in the state of Michigan, it's, everything is done a certain way. The law is very specific on landlord tenants, and if you're going to be managing the property yourself, even if you do use an attorney, you also do want to get familiar with landlord tenant law so you really understand what does the process look like, what are the outcomes, that type of thing, because you have to give the tenant a specific amount of time of notice when they stop paying their rent. It's called 7-day notice, a notice to quit. Once the 7 days expires and they have not paid, then you can file for the eviction in court. You can file the demand for possession. And there's all sorts of timing and things that go along with it and hearings. And so you want a legal professional to help you handle this. It's totally worth it. But you definitely also want to know at least enough about it to know, to keep up and to be able to make decisions about your own property. So I guess the bottom line is hopefully you don't have to deal with anything like that, but depending on what type of property you're investing in, you might be opening yourself up more to people not paying rent on time if you are, dealing with a higher risk area with the potential for higher returns. So, okay. So I think the last thing I wanted to talk about was city inspections and our landlord licenses, they're often called. So every municipality does things different. Every municipality has requirements that are different to maintain your property to the standards that the city had set forth. So for instance, in the city of Detroit, you have to have an inspection, and you also have to have a lead inspection and abatement for your property. And you have to renew so many years, where, I think it's 2 to 3 years. They just changed things recently, so I'm not 100% sure about this. But for instance, some other cities, I think Detroit's one of the only ones that actually has a lead abatement requirement. There's some other cities where you have to get the property inspected every 3 years, every 5 years. Sometimes it's only the exterior. I think West Bloomfield is like only the exterior you have to get inspected, and maybe that's changed. So you also want to know what your expectations are with every single municipality, and just make sure that you're keeping up with those requirements, especially because if you do end up in court at any time with an eviction hearing, there are some municipalities that will not even allow you to evict your tenant for non-payment if the property is not compliant at the city. So this is really important to be able to sort of understand what your obligations are in the city, to keep up with them, to make sure that you are allowed to do what you need to do. There are some cities that will come down really hard on you if they find out that you are renting your property and you do not have the proper landlord license. Hazel Park is one of them. I think probably Warren is another one. So you really want to understand which cities are more friendly to investors. Are you going to work with your property manager to stay compliant in properties or is that something you are going to take on yourself? So you really need to understand what your obligations and requirements are so you know how to handle it. So those are all of the, I would say, the various aspects of owning and purchasing investment property. So once again, I want to thank everybody for joining. If there are any questions, I'd be more than happy to answer. There's been a couple that have been coming in, and I've been sort of like answering them as incorporating them into the information. But if there's anything else, I would be more than happy to answer it. Feel free to DM me if you want, if you want my help or advice. I'm more than happy to consult with you about any property that you currently own, any property that you're looking to purchase. If you'd like to enter the foray of being an investor, like I said at the top of the talk, I think it is an incredible way to build wealth and passive income, and it's much easier to sort of get a hold of and really understand what you're doing than something like the stock market, which has so many different variables and so much to really understand. So I really appreciate everybody joining me today. This has been so much fun. I'm going to do this every week, and it's going to get better and better because last week was the first time doing it. I didn't know what I was doing at all this week. So thank you David, for watching. I see you. I really appreciate you being on here the whole time. That's it. Again, send me a DM if you have any questions at all. I hope you have an awesome evening, and good night.